Ever felt that knot of anxiety in your stomach as the cryptocurrency market takes an unexpected nosedive? You're not alone. The exhilarating world of digital assets comes with its own set of thrills and, yes, spills. But what if I told you there's a powerful tool in your arsenal, a safety net of sorts, that can help you navigate these turbulent waters and protect your hard-earned investments? We're talking about stop-loss orders. Now, if you're scratching your head wondering what exactly a stop-loss order is and how it can be your best friend in the often volatile crypto landscape, you've landed in the right place. Today, we're diving deep into the world of Gemini, a leading cryptocurrency exchange, and uncovering how you can effectively utilize their stop-loss order feature. Before we get into the nitty-gritty of how to set up these crucial orders on Gemini, let's take a step back and understand the fundamental importance of risk management in cryptocurrency trading. The crypto market, unlike traditional stock markets, operates 24/7 and is known for its rapid and often unpredictable price swings. A tweet from a prominent figure, a regulatory announcement, or even just market sentiment can send prices soaring or plummeting in a matter of minutes. Imagine you've invested in a promising cryptocurrency, let's call it Novacoin. You bought it at $10 per coin, confident in its long-term potential. However, the market takes an unexpected turn, and Novacoin's price starts to decline rapidly. Without any protective measures in place, you could watch your investment dwindle, potentially facing significant losses. This is where a stop-loss order comes into play. Think of a stop-loss order as an instruction you give to the exchange to automatically sell your asset if its price drops to a specific level. This predetermined price is your stop price. Once the market price of your asset reaches or falls below your stop price, your stop-loss order is triggered, and it becomes a market order, an order to sell immediately at the best available price, or a limit order, an order to sell at a specific price or better. Why is this so important? Well, it acts as a crucial safeguard against significant losses. By setting a stop-loss order, you're essentially saying, if the price of my Novacoin drops to, say, $8, I want to automatically sell it to limit my potential downside. This proactive approach can prevent emotional decision-making during a market downturn and help you preserve your capital. Now that we understand the why, let's get into the how, specifically, how to utilize Gemini's platform to set up stop-loss orders. Gemini, known for its user-friendly interface and robust security measures, makes it relatively straightforward to implement this essential risk management tool. First things first, you'll need to have a verified and funded Gemini account. Assuming you've already cleared that hurdle, the next step is to navigate to the trading interface. Typically, you'll find a section labeled Trade or something similar on the Gemini platform. Once you're there, you'll usually see different order types available. Look for options like Buy, Sell, Limit, Market, and crucially, Stop. Gemini might present this as Stop Limit or simply Stop. The key is to identify the order type that allows you to specify a trigger price for selling. Once you've selected the stop or stop limit order type, you'll be presented with a few key fields to fill in. These typically include the asset pair. This is the cryptocurrency you want to trade and the currency you want to trade it against, e.g., BTC/USD, ETH/USD, or in our earlier example, Novacoin/USD if it were listed. Make sure you've selected the correct pair for the asset you want to protect. The stop price. This is the crucial trigger price. It's the price at which your sell order will be activated. If the market price of your asset reaches or falls below this price, your order will be initiated. When setting your stop price, consider your risk tolerance and the volatility of the asset. A tighter stop loss, closer to your purchase price, will offer more protection but might be triggered by minor price fluctuations. A wider stop loss will give the asset more room to move but exposes you to greater potential losses. The limit price. For stop limit orders, if you've selected a stop limit order, you'll also need to specify a limit price. This is the specific price at which you want your sell order to be executed after the stop price is triggered. Your order will only be filled if the market price reaches or is better than your limit price. This gives you more control over the selling price, but also introduces the risk that your order might not be filled if the market moves too quickly past your limit price. The amount. This is the quantity of the cryptocurrency you want to sell when the stop price is triggered. You can usually specify this in terms of the cryptocurrency itself, e.g., 1 BTC, 5 ETH, or as a percentage of your holdings. Once you've carefully filled in these fields, double-check all the information to ensure accuracy. A mistake here could lead to unintended trades. After you're confident, you'll typically click a button labeled Place Order, Sell, or something similar to submit your stop-loss order to Gemini. It's important to understand the difference between a stop order and a stop limit order on Gemini, as the platform might offer both. A simple stop order, once triggered, usually becomes a market order, aiming to sell your assets at the best available price at that moment. This offers a higher probability of your order being filled but doesn't guarantee a specific selling price. A stop limit order, as mentioned earlier, provides more control over the selling price. However, it comes with the risk of your order not being filled if the market moves rapidly past your limit price after the stop price is reached. Choosing between these two depends on your trading strategy and your priority: guaranteed execution with a market order or price control with a limit order. Now, let's consider some practical scenarios and tips for effectively using stop-loss orders on Gemini. Setting realistic stop prices. Don't set your stop loss too close to your entry price, especially for volatile assets. Minor fluctuations could trigger your stop loss prematurely, causing you to sell at a loss only to see the price recover. Consider the asset's historical volatility and typical price swings when determining your stop price. Technical analysis tools, such as Average True Range, ATR, can help you gauge volatility. Using percentage-based stop losses, instead of fixed price levels, you might consider using percentage-based stop losses. For example, you could set a stop loss to trigger if the price drops by 5% or 10% from your purchase price. This approach adapts to the price level of the asset. Scaling in and out with stop losses. If you're employing a strategy of buying in increments, dollar cost averaging, you might consider setting stop losses at different levels for each purchase. Similarly, if you're gradually selling your holdings, you can use trailing stop-loss orders, if Gemini offers them, which automatically adjust the stop price as the asset's price moves in your favor. With that said, thanks for watching, and until next time.